Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at KRESS Cooper. Today I will be taking you through the topic of today, which is on tax group. We have started discussing this topic since last week. The tax group guide has come out from FTA in January, and since then we have been discussing different sections of the guide. So last week we had discussed what is a tax group, what are the conditions to form a tax group, and this week we will take this guide forward and we will be discussing how to form a tax group, how to do deregistration, what happens, between the life cycle of a tax group when when a new company joins, when a company leaves a tax group. So if you have missed any of our previous lectures, the previous lecture on this tax guide or any of our previous lecture, you can always go to our YouTube channel. All these webinars are there. If there's any question, you can always email us at info@crestcooper.com. So let me start with a recap of the previous chapter about the tax group. Now, what is a tax group? So when two or more taxable persons meet the conditions under the corporate tax law, which we will be discussing in the later slides, they are treated as a single taxable person. And then all the laws apply to that one tax group instead of the individual entities. So now this corporate tax group is different from a VAT group. So let's not confuse the two. And the condition to form a VAT group are totally different to a condition to form a corporate tax group. If an entity, if you already have a VAT group and there are certain entities there of the group, it doesn't mean that the same entities will need to be looked at for corporate tax group. So these two things are distinct from each other. There can be a VAT group and a corporate tax group separately, and you will need to meet the condition under the law of the VAT and corporate tax separately to form these groups. So what are the benefits of the tax group? So if there is a tax group, then the single return will need to be filed, like we said, that under the tax group, this is treated as a single taxable person. The losses and income of the members, they can be offset between each other. There can be the transfer of assets and liabilities, any transaction between the members of the group, they can be disregarded when we are determining the taxable income of the tax group. So what are the conditions to form a tax group? Like we said that all the conditions need to be met. So under the guide, these conditions have been named as judicial person condition, resident person condition, share capital ownership condition, voting right condition, profit and net asset condition, exempt person condition, qualifying fee zone person condition, financial year condition, accounting standard condition. So we will be discussing all these conditions in detail. But the most important part is that all of these conditions need to be met. So if one of or more are not met, then you cannot be qualifying for a tax group. Also, the other important point is that these conditions need to be met for the whole tax period. So consistently, they need to be met if you need to keep this tax group. So let's start with the first condition, the judicial person condition. So this condition says that the person should be a judicial person, which means that it should have a legal entity, legal status. So judicial persons are those that are basically like companies, private and public joint stock companies or limited liability companies. By this definition, the natural persons are excluded because natural persons are not separate and distinct from the legal, business. So, for example, the sole establishment or unincorporated partnership, the natural person are treated as the same. So they are excluded for this condition and they cannot be part of the tax group. Freelancers cannot be part of the tax group, civil companies, sole establishment, unincorporated partnerships. The second condition that needs to be met is the resident person condition. So now a judicial person also needs to be a resident person. So when is a taxable person a resident person? It is when either they are established under the laws of UAE or they are established under a foreign legislation, but they are effectively managed and controlled in the UAE. So also we need to look at the double taxation. So sometimes there are double taxation agreements, which are bilateral agreements between UAE and other countries, and they are there to eliminate double taxation. So under these double taxation agreement, there are certain rules that determine the residence of the company. So if under that double taxation agreement, the residency is for UAE, then there will be a resident of UAE. Otherwise, there will be a resident of the other jurisdiction. If there is no double tax treaty between UAE and the other foreign jurisdiction where the company is established, then it can be a resident person if they're required to pay taxes in both of these jurisdictions. That can be part of this tax group. So, like we said, for that it needs to be a resident judicial person. So, a foreign company, they cannot be part of a tax group. because they're not resident person. But in this case, where if, for example, we can look at this example where the company F is outside UAE, established outside UAE, they cannot be part of a tax group. But through a subsidiary like company E, which can act as a parent company because effectively they have, more than company E to. Yeah, sorry everyone for the technical difficulty. I think that you are not able to see my screen. So like I said that in this example, if there's an agreement to transfer an economic ownership of these shares, like in this example, company C has transferred 20% of its shares to company A for company B, but here this will not be counted as the share capital ownership condition is met because we need to have a legal ownership change, not like an effective ownership change. So in our last webinar, we had discussed this example as well. Let me take you through this. This is a case of indirect ownership. Webinar, we were discussing if, why this company A has a direct, investment in company B of 90%. So it's owning this company directly 90%. But through company C, it has effectively, it owns 80% of company C, and company C in turn owns 10% of company B. So in our last webinar, we were discussing if this can become an effective shareholding because 80% of and 10% would be 8, so 98%. But in this condition, what I wanted to clarify is that company C needs to be a subsidiary of company A, and to be a subsidiary, it needs to have a 95% shareholding. So since company A does not have a 95% shareholding in company C, in turn, it cannot then, be an indirectly, company A cannot indirectly hold, this 8% through company C. Now, let me switch this example where the company A owns 95% of company C and only 5% is owned by third party. In this case, 90% is owned directly. And since company C is now a subsidiary of company A because it owns 95% of the share, then in turn, this 10% can be taken as the effective ownership. So then it would be 9.5%. So then now the company A can have a tax group with company B in this case. So just a little clarification from our last webinar. The next condition that needs to be met is the voting right condition. So this voting right condition requires the parent company to hold at least 95% of the voting right in the subsidiary. And this should be, it is indirectly or directly can be done, but indirectly it should be through intermediate subsidiaries. So now, normally when ownership conditions are met, people assume that voting right conditions are also met, but it's not the case because there might be that there are some restrictions on the voting right, or voting rights do not align with the nominal share capital ownership. So we have to look at both these conditions separately. They cannot be taken that one is being met, so the other would also be met. And to see this, we can see if, the voting rights, they require shareholder approval or board approval, because shareholder approval is relevant here, board approval is not relevant. We need to also see that legally who holds the voting rights on the shareholder matters. Where there is a case where the subsidiaries have, issued shares with voting rights and without voting rights, then the shares without voting rights will not be considered in this case when we are looking at this condition. So it is possible that share capital ownership condition is being met, but voting rights condition is not being met. The next condition is profit and net asset condition. So this condition requires that the parent company should either directly or indirectly be entitled to at least 95% of subsidiaries profit. This profit can be distributable profit or profits that are not distributable, or 95% of the subsidiary net asset in the case of liquidation or winding up. So if these conditions are met, so then only company can form a tax group. The next condition is exempt person condition and qualifying fee zone condition. So an exempt person and a qualifying free zone person cannot form or join a tax group. Okay, now in case of a free zone person, if a free zone person is not a qualifying free zone person, since it is not doing any qualifying activity or not meeting the de minimis threshold, or it is a qualifying free zone person but it has opted out of that and wants to be taxed in the normal regime, so that free zone person can still qualify to be in the tax group. Any branches of a non-resident person, for example, a branch of a non-resident person can be a free zone person who's not a qualifying person, but they cannot be part out of tax group because they're not judicial person. Branch is not treated separately than its owner. So basically, the main company and branch is one, and a branch is not a separate legal entity. For exempt person, they cannot form part of the tax group. Only exception is for the taxable subsidies of government entities. If they're meeting all the other conditions, then they can form part of this tax group. Let's talk about small business relief. Small business relief is also applicable on the tax group, but we will have to look at this small business relief as the tax group as a whole. We cannot look at the entity separately. For example, there are three members, A, B, and C. A has 3 million turnover, 2 million turnover, B has 1 million, and C has 500,000. So we will not look at each of them separately that they qualify for small business relief. We will add them up, consolidate the revenue. In this case, it would be 3.5 million, and it will not meet the small business relief requirement. So we have to look at it as a whole. Then there's a financial year condition. So another condition is that all the members have to have the same financial year. In case if they do not have the same financial year, they need to apply to FTA and to have them change. So either the parent can change it to one of the member if they're not the same, or the member can also change. So let's take this example. Company A has a year end of 31st December, and company B has one of 31st August. And on May 3rd, May 2024, company A has bought all the shares in company B. So now company A can either change the financial year to 31st August, or it can be the opposite. So if the company A is changing its year, then the first tax period approval and the tax group will be effective from 1st September 2025. Or if it is the other way around and company B has changed it to 31st December, so then the tax group will be effective from 1st of January. So this approval needs to be taken if this financial year do not align for all the members of the tax group. The next is the accounting standard condition. So this says that all the members of the tax group need to prepare financial statements using the same accounting standard. So under the law right now, we know that if there is revenue does not exceed 50 million for a company, they can go for IFRS. For SMEs, if it is more than 50 million, they need to go for IFRS. But if you are in a tax group, you need to align this. And if one is having using IFRS, other is using IFRS for SME, they cannot be part of the same tax group. So this needs to be aligned. So now let's move on to our current lecture, which is on the formation of the tax group. We will look at how a tax group is formed and go till the end to the deregistration and everything in between, the whole life cycle. So now when all the conditions of the tax group have been fulfilled, and a parent company can now has an option to establish a tax group. So not necessarily that all the conditions are fulfilled for all the subsidies and you need to necessarily compulsorily form a tax group for them, because it is only at the discretion of the subsidiary and the parent if they both wish to have a tax group. If it is serving any purpose, then you can form this tax group with those subsidiaries which are also meeting the condition and also willing to join. So when this happens, the parent company and whichever are the interested subsidiaries, they need to jointly apply to FTA to form this tax group. This application will also give propose the tax period in which they want to be part of this tax group. This application also needs to be given before the end of the current tax period, so in which they want it to be a tax group. So just remember that for the subsidiary and the parent company, they will need to register for tax, corporate tax individually first, have a TRN, and then apply for the tax group. When they do, it will be similar like VAT, that they will get suspended and a new separate TRN for the group will be given. But unlike the VAT, where there was an option to join directly into VAT groups, that is not there for corporate tax. You do need to have a separate registration and then apply for the group. So once the tax group is formed now, so the parent company assumes certain responsibilities on behalf of the group. So they're acting as the representative member, like in the VAT group. So the responsibilities they have under the corporate tax is any application process, they need to give that, jointly with the subsidiaries who want to join the tax group. They need to prepare the consolidated financial statements for the whole group. They need to be responsible to file the tax return for the company, settle the corporate tax payable, apply for the tax refund if conditions are being met, manage the registration, deregistration of the group. They need to maintain the proper supporting documents for these returns. They need, and if any clarifications required, on any topic, then they will be the one who will be submitting this clarification or as part of, on behalf of the group. Now, under the tax group, we have talked about that tax group treats all these members as a single taxable person for this corporate tax, and it is represented by this parent company, and this parent company is, like we just said in the last slide, liable to settle this corporate tax within the due date, which is 9 months from the end of the relevant tax period. So if, for example, tax period is January to December 2024, the return should be filed by September 2025, and same the corporate tax liability needs to be discharged at the same time. So if the parent company fails to do this, then this payment and any invested penalty will be applied on the whole group, and all members will be liable for this. Now, there is a way to limit this liability and restrict it for some members, but you will have to specially apply to FTA for this. Deregistration for a tax group. So now, if the company wants to deregister, so the only way to deregister is if the company, if all the members of this tax group have basically stopped the business activity. If, for example, one person has stopped the business activity, that doesn't mean the whole group needs to be dissolved. That company can leave the tax group, but we will need to look at it at the entire level of the tax group. And if the condition would be that all of the companies have stopped this business, then or they don't want to be part of the tax group, or disbanded. So if this happens, then only the parent company can apply to FTA to cease this. So first they will apply to the FTA, then they will settle all the corporate tax penalties and the payments, file the last return, and then after approval, this deregistration will happen. So now during this life cycle of the group from formation to deregistration, it could be that, in the tax group, a new member has joined. So let's talk about that. So when a subsidiary is joining the tax group, it needs to meet all the conditions, and this parent and the subsidiary will need to apply for this registration. Again, it will need to give the tax period that is intended for the company to join in the tax group. So either this application again will need to be submitted before the end of the tax period in which the joining of this tax group is requested, just same as like when we are making the tax group. So either the approval can be given from the date which is in your application, or FTA can decide a new date. For any new, parent company or subsidiary company who's joining the tax group, then they will join from the date of the incorporation. Leaving the tax group. So now either a subsidiary can voluntarily leave a tax group, okay? So, or it has to mandatory basically leave the tax group. So following, like if it is voluntary, then they can give this application from the beginning of the tax period in which they want to leave and get the approval. Or if they are no longer meeting this condition, it could be that the ownership have changed. Maybe they're not meeting the 95% ownership or any of the other conditions which we have discussed in our last lecture. So if they are not meeting any of the condition, they need to notify FTA within 20 business days that they are no longer meeting this condition. And this is mandatory that they need to do. Now, if a subsidiary is transferring its business due to, let's say, merger, so then that subsidiary will remain a member until it ceases to exist. And the tax group will continue to exist, only the subsidiary will leave. The only way where this subsidiary, in the case where there are only two members in the group and one member is basically no longer, it exists because of this merger or transfer. So then only this will go into deregistration, basically. So there could be a case where there could be a change of parent company. So if there is a change in the parent company, the tax group doesn't need to be discontinued. Without this discontinuation, there are circumstances where we can change the parent. So if the new parent is meeting all the conditions, then they can request to be part of this as a replacement of the old parent company. Or if the former parent company is no longer there and the new, subsidiary or the parent is a universal legal successor, then in that case also, the parent company can be changed without discontinuing this tax group. For the second point, where it is the universal legal successor, so for that, an application can be submitted even before this transfer has been completed. Only in this case, and but this, of course, it will be conditional on that the transfer will get completed, but an application can be made during this, change. So that's it from us. So today we have already, like I said, discussed what are the conditions to form a tax group. Today we discussed all the administrative, how to form the tax group, what happens at registration when a new parent comes in, company wants to, come inside a tax group, leave a tax group. And for our next lecture, next week, we will be discussing the taxable income of a tax group. And we will try to finish this guide in our next lecture, so then we can move on to some other topic. Mahar is there, I'm there, and we have a team of professionals who work for us, who you can contact for any query for corporate tax. And you can always email us at info@krescooper.com, like I said, or watch our webinars at our YouTube channel. And if there is any questions, you can always email us or call us. Thank you very much for joining. So I don't think there's any questions for today. So if there is any question that you think of later, you can always email us and contact us on our number, like I said. So thank you everyone for joining for today's session, and looking forward to seeing you in our next session. Thank you.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.